Hello and welcome to the Global View on this Tuesday. Well, let's take a look at what's going on at a macro level. Longer dated US Treasury yields edging higher following Moody's cut to the credit rating outlook for US government debt. The AAA credit rating outlook was cut to negative from stable, with the ratings agency citing large fiscal deficits and a decline in debt affordability. The US faces another partial government shutdown this Saturday if Congress does not pass a stopgap spending bill. A Republican spending measure unveiled on the weekend has failed to find bipartisan support. Well, the yield on the US 10-year Treasury note was up to 4.64% and the 2-year slightly lower at 5.04%. And yields dropped from earlier highs after New York Fed's latest survey of consumer expectations showed inflation running at 3.6% a year from now, down from estimates of 3.7% in September. Well, the Aussie dollar is trading higher at 63.8 US cents. The US dollar climbed to its highest level in more than a year against the Japanese yen, but then fell sharply, with the Japanese finance minister saying the government would keep monitoring the currency market and respond appropriately. And the British pound strengthened after a reshuffle of key government posts by UK Prime Minister Rishi Sunak, who's appointed former PM David Cameron as Foreign Minister. Let's take a different look at global insights today. And global markets and economies continue to be hamstrung by inflation and interest rate concerns. This ahead of key CPI data released from the US this week, which will provide some clues on whether global interest rates have indeed peaked. Well, for more on this and also what we're seeing in Australia, we're pleased to welcome George Tharenou, UBS Chief Economist Australia, live from the UBS Australasia Conference in Sydney. George, welcome to ausbiz. Thanks very much for talking to us. Let's start in the States. Of course, we get that key read on inflation tomorrow morning, our time, followed by retail data. What are your observations of how the US economy is travelling at the moment and the likely path of interest rates from here on?
Well, the key thing for the US has been resilience of the economy. So we've seen growth rates through the middle of this year tracking up towards 3% in real terms, which has really confounded the consensus, which looked for a slowdown in growth. And so on the back of that, the Fed has kept alive the prospect of one more rate rise, but they've backed off the likelihood of that. And really the key thing will be tonight's inflation data. It's probably going to show at a headline level quite a modest increase, close to just flat on the month because of the fall in oil prices. But what really matters for markets and the outlook for the Fed is if you see some underlying inflation pressures which are a bit more sticky. It's not the final decision. There'll be another inflation print before the next meeting, but for now the likelihood is the Fed looks like they're signalling they're done in terms of their rate rise cycle. But if you were to see a couple of high inflation prints, it would raise the probability they could start to raise rates once more time.
Well, and what are you seeing just as far as the US consumer is concerned? Once again, remaining fairly resilient there. I guess we'll get a greater read by that retail data, but also we've got a number of retail companies reporting this week as well.
Yeah, the health of the US consumer has been the real upside surprise for the US and global economy this year. Despite the rate rises and quite a significant lag of policy, what's happened is the labour markets remain resilient. So you've seen a slowing or an easing in the labour market, but jobs growth is still pretty positive. And so retail sales have bounced back over recent months. And if that trend were to continue, it would signal that the US economy keeps chugging along. But our expectation is looking forward over the next year, given the high level of rates, and probably will stay at this level for several months at least, you are going to see a slowdown in the US economy. The question's quite open still whether it falls into recession. It probably is going to weaken quite materially from here, but for now the US is holding it together.
Is there a likelihood of a rate cut sort of by mid next year? Certainly futures markets pricing in one as early as May. Is that realistic?
Yeah, I think it is, because in the US we've seen the Federal Reserve signal that as long as inflation is heading back down towards their target range, what it means is real interest rates, so the nominal Fed funds rate less the inflation rate, is actually tightening. And so they're quite concerned about the fact that they need to follow the inflation rate downwards with a policy path to avoid excessively tightening the economy and tipping into recession. So I think the likelihood is, based on what the market's expecting and UBS as a house, you will see the Fed start to cut rates next year.
George, let's turn to what you're seeing in Australia at the moment. And many economists I speak to say the economy, the Reserve Bank, about 6 months behind what we're seeing in the States at the moment. Yeah. Would you agree with that?
Yeah, that's right. So Australia, going back to COVID, was late to reopen. And when we did, we had a lot of excess cash built up and extraordinarily low interest rates. So we saw a very sharp rebound in the Australian economy, and that added to inflationary pressure. That really surprised the RBA to the upside. And that's really been a story that's continued over the last year, where the RBA has been quite cautious in terms of its commentary, thinking about the idea of having a narrow path or soft landing. In other words, not overly tightening, not tipping the economy into recession. But the trade-off has been that the inflation outlook is higher for longer. And so we saw that in their commentary last Friday, where they revised up their inflation outlook, and it remains at the top of the target band all the way out to 2025. So from the market's perspective, what that means is that the RBA was slow to raise rates and didn't reach the levels of other major central banks like the Fed. And so the likelihood, in my view, and what the market's pricing, is that the RBA is looking at a higher for longer scenario for both inflation and interest rates. And they're going to have to wait for inflation to come down before they can start to ease. So I think they're more likely to be after the Fed rather than before.
And I see that you're saying perhaps what's eroding perhaps the effectiveness of those rate hikes that we've seen from the RBA is the record level of immigration at the moment, and also strong fiscal spending.
That's absolutely right. The key difference domestically for Australia in terms of the policy support that's going on and keeping the economy relatively resilient is the absolute boom in population growth. We're seeing growth rates of around 2.5% in real time, and migration that's exceeding 500,000. These are record high levels and far in excess of what would have been expected. And when you've combined that with the strength of public demand growth, which is in nominal terms growing around 8%, it's a real underpinning for the economic outlook, and is a key reason why the RBA upgraded their growth assessment. The question mark here is, what does it mean for inflation? And I think in the near term, it is putting a lot of pressure on the housing market, particularly rents. So what that means is the RBA had to come back at its last meeting and raise the cash rate again to try to ensure that inflation falls back to target. Looking forward over the next couple of years, you are going to see a slowdown in that public and population growth, but for now, it's really a key factor that's keeping the economy quite solid.
So George, you've been very accurate in your forecasting of Reserve Bank moves. Let me ask you then, what your expectations are. Are they at the peak now? What do you see going ahead?
So the baseline for me is the RBA signalling they're done and they're not looking to raise rates again. They softened their so-called tightening bias. It's more of a question mark whether, quote unquote, they actually raise the cash rate further from here. So the way I framed it is, if the RBA is forced by a higher than expected inflation print that comes out in late January, it would make the February meeting live, and there's a potential of one more rate rise of 25 basis points at that meeting. But the likelihood is that the RBA will sit back and wait for the lags of the prior tightening and hope that inflation is just tracking down towards their target. And if that's the case, that's most likely, then they'll probably sit at this peak level for probably a year or so. And then if the US Federal Reserve is starting to cut rates and inflation's heading back down towards the target band, the RBA will think about starting to cut rates, but that's not really until late next year.
Yeah, so how do you see the Australian household travelling at the moment? Clearly receiving a boost from that change in the up of the minimum wage. Excess household savings, although they're being run down at the moment.
Yeah, so the household sector has been relatively resilient, supported by the build-up of excess savings during COVID. But that stimulus is starting to run out. Households have run down their savings rate to a very low level versus history. But what's really starting to take over as the primary driver is pretty solid wage income. In the last GDP print, it's been growing at high single-digit rates, so between 8 and 10% over the past year. And part of that, as you mentioned, is the award and minimum wage decisions, where government-regulated wage increases are very large. So there's many households who are benefiting from large increases in wages in nominal terms, but real spending power has been quite diminished because inflation's eating up a lot of that nominal income. So what that means is you've got quite a bifurcated consumer. There's a bunch of households who are older, who are benefiting from higher interest rates and interest income. There are some who are getting direct regulated wage increases that's supporting their disposable income. But there's also another bucket of households who are feeling the real financial squeeze, where higher rates are flowing through to their mortgage borrowing, and they're having to service a lot of debt, and it's a very difficult outlook for them. So the overall picture is pretty mixed, but for me, it's probably more a case of a muddled through scenario.
Yeah, how does the RBA weigh that up then? When you talk about that bifurcation, particularly, and a lot has been made of this, of those older household, the boomers, that aren't saddled with that debt at the moment. In fact, they're benefiting given what the income they're receiving from those high interest rates on their savings. But a very different story, of course, at the other end of the demographic.
That's right. There's an absolute extreme bifurcation where there's a portion of households, about 35% share of the total, who have mortgages. And as interest rates have gone up, they've been paying much higher repayments on their mortgages. But there's also a lag here because a lot of households had fixed mortgage rates they borrowed out during COVID as part of the RBA's term funding facility, and they could borrow at around 2%. And they've been reset to mortgage rates around 6%. So there's a fair degree of pain to come just based on the prior rate rises. And that had been something which a lot of commentary, particularly the RBA, thought would have a more materially negative impact on the growth outlook. But at the same time, you've had this other bucket of households which really didn't exist before. Older households who have got assets in superannuation savings, they're getting income from that that's worth about $100 billion a year, or about 8% share of their income. And they're also benefiting from higher cash returns on term deposits, 5 or 6% interest rates now, and they're willing and able to spend it. So as long as this continues, which seems quite likely, you're going to have the economy where you've got very mixed trends. And the RBA has got a bit of an issue here because for them, they've only got a blunt tool, the cash rate. And that's why I think they'll sit here and wait, because the mix of these trends is what happens to inflation was what really matters. And that's the key thing for them.
George, great to get your outlook. Thanks so much for joining us from UBS.
Thank you.
All right, just a quick check of the markets before we wrap it up, and we are expecting a significantly higher opening. As you can see, up almost 1% there as far as SPI futures are concerned. Well, stay with us because the open is just a couple of minutes away.